Here's a number that should bother you. 95%. That's roughly how many people who invest, who actually try, never build the kind of wealth that changes their life. They open the account, they buy the stocks, they watch the charts, and decades later, they end up with not much. So the question isn't whether you're investing. The question is, are you investing like the 95% or the 5%? Because the difference has nothing to do with luck and almost nothing to do with how much money you started with. It has everything to do with a small set of decisions that most people never even realize they're getting wrong. Let's find out which side you're on. Welcome to VestWise, where we explain investing concepts in a simple way. Quick note before we dive in. This video does not contain any financial advice. Everything we cover today is purely educational, so you can make the best decision for yourself. All right, let's break it down. Think about everyone you know who invests. Your coworker who checks his portfolio every morning. Your friend who bought crypto at the peak. Your uncle who's been almost ready to retire for 15 years. Most of them are trying, really trying. But trying isn't the same as doing the right things. Think of it like this. Imagine 100 people all trying to cross a river. 95 of them jump in and start swimming, fighting the current, exhausting themselves, some making it halfway before turning back. 5 of them? They walk upstream for 10 minutes first, find the shallow crossing, and they walk across. Same river, same destination. Completely different approach. That's what separates the 95% from the 5% in investing. It's not talent. It's not timing. It's not even luck. It's the approach. And today, we're going to cover exactly what that approach looks like in 6 specific differences that separate investors who build wealth from those who just participate. Let's break it down. Here's the first and most fundamental difference. The 95% invest reactively. They see a stock going up, they buy. They hear a tip from a friend, they buy. They watch the market drop, they panic sell. Then they buy again when it recovers. They're not investing, they're reacting. The 5% do something completely different. Before they buy a single share, they have a system, a target allocation, a contribution schedule, a rebalancing plan, a clear investment goal with a timeline. Think of it like this. Imagine 2 people going to the grocery store. Person A has no list. They walk in hungry, grab whatever looks good, spend twice their budget, and get home realizing they forgot half of what they actually needed. Person B has a list. They know exactly what they need, how much they're spending, and they're out in 20 minutes. Same store, same products, completely different outcomes. Investing without a plan is just expensive guessing. The 5% don't guess. They execute a system consistently. Most investors spend the majority of their time and energy trying to find the best investments. The stock that's going to 10 times, the sector that's about to explode, the fund with the highest return last year. But here's the catch. Chasing the highest return almost always leads to taking on the most risk. And more risk doesn't mean more reward. It often means more loss. According to Morningstar's annual Mind the Gap study, the average investor consistently earns less than the funds they invest in. Not because the funds are bad, because investors buy at the top, excited by recent gains, and sell at the bottom, terrified by recent losses. They chase performance, and performance chasing destroys wealth. The 5% think about it completely differently. Their first question isn't, "What's the best return I can get?" It's, "What's the most risk I can afford to take given my timeline, my goals, and my situation?" They manage the downside first, and they let the upside take care of itself. Think of it like driving. The 95% are focused on going as fast as possible. The 5% are focused on not crashing, knowing that staying on the road long enough always gets you further than driving fast and hitting a wall. Here's the uncomfortable truth about investing. Your brain is working against you. Humans are wired for loss aversion. We feel the pain of losing money roughly twice as intensely as we feel the pleasure of gaining the same amount. Which means when the market drops 20%, it feels catastrophic. Even if you've gained 40% in the 2 years before that. The 95% make decisions based on how they feel. When the market is up, they feel confident, they buy more. When the market is down, they feel terrified, they sell. But here's the thing. That's literally the opposite of buying low and selling high. The 5% remove emotion from the equation. They have preset rules. If the market drops 20%, I will buy more, not sell. I will rebalance my portfolio every 6 months, regardless of how I feel. I will not check my portfolio more than once a month. Rules. Written down, followed consistently. Think of it like a pilot. Pilots don't fly by feel. They follow checklists. Every single time, even when everything feels fine. Because feelings aren't reliable at 35,000 feet, and feelings aren't reliable when your retirement account just dropped $30,000 in a week. According to a landmark study by Dalbar, over a 20-year period ending in 2022, the S&P 500 returned an average of 9.65% annually. The average equity fund investor? 5.5%. Same market, same funds. 4% less every single year because of emotional decision-making. Over 20 years on a $100 investment, that's the difference between $630,000 and $293,000. Emotion is expensive. This one quietly destroys more wealth than almost anything else, and most investors never even notice it's happening. Fees, not dramatic crashes, not bad stock picks, fees. The 95% look at an expense ratio of 1% and think, that's nothing, 1% is basically zero. But here's the catch, it's not nothing, not even close. Think of it like this. Imagine 2 identical gardens. Every year, one garden has 1% of its plants quietly removed. The other garden keeps everything it grows. After 5 years, the difference is small. After 20 years, the garden losing 1% every year has dramatically fewer plants because it's not just losing plants, it's losing the offspring of those plants, the compounding of compounding. According to a Vanguard study, the difference between a fund charging 0.03% annually versus one charging 1% annually on a $100,000 investment over 30 years, assuming 7% gross returns, is over $150,000. $150,000 lost not to bad markets, lost to fees. The 5% know this. They choose low-cost index funds. They read the fine print. They ask, how much of my return am I keeping? Because in investing, what you keep matters just as much as what you earn. Of all the differences on this list, this might be the most important one, and the most human one. Investing is easy when markets are going up. Everyone's a genius in a bull market. But what happens when the market drops 30%? When your portfolio that you've been building for years suddenly looks like it's been cut in half? The 95% stop. They pause contributions. They move to cash. They tell themselves they'll wait until things stabilize. But here's the thing. The best time to invest is almost always when it feels the worst to do so. Think of it like a store having a massive sale. If your favorite store put everything at 30% off, you wouldn't stop shopping there. You'd buy more. That's what a market crash actually is, a sale on assets. But because it feels terrifying, because the headlines are screaming, most people do the opposite of what logic would suggest. The 5% keep going, not because they're fearless, but because they understand that time in the market beats timing the market every single time. According to research by Charles Schwab, an investor who missed just the 10 best trading days in the S&P 500 over a 20-year period, ended up with less than half the returns of someone who stayed fully invested the entire time. 10 days out of more than 5,000 trading days. Half the returns. The cost of stopping, even briefly, is enormous. And finally, the difference that makes all the others possible. The 95% invest based on tips, headlines, and gut feelings. They follow what's trending on social media. They buy what their coworker recommended. They make 6-figure decisions based on 5-minute videos. The 5% invest based on understanding. They know why they own what they own. They understand the businesses behind the tickers. They've read the basics, how markets work, how compound interest works, how economic cycles affect different asset classes. And because they understand, they don't panic when things drop. They don't chase when things spike. They don't need someone else to tell them what to do. Knowledge doesn't just make you a better investor, it makes you a calmer investor. And calm investors make better decisions. And better decisions, made consistently over decades, is exactly how the 5% get to where they are. 95% investor versus 5% investor over 30 years. Let's put all of this into one final picture. Two investors, both start at 25. Both invest $400 a month. Both use the same S&P 500 index fund. Investor A, the 95%, chases performance, panic sells during downturns, pays 1% in fund fees, takes breaks when things feel uncertain, earns roughly 5% net annually after fees and poor timing decisions. Investor B, the 5%, has a plan, ignores noise, uses low-cost funds at 0.05%, keeps contributing no matter what, earns roughly 7.5% net annually. By age 55, after 30 years, Investor A has approximately $330,000. Investor B, $567,000. So to wrap everything up, the 6 differences between the 95% and the 5%. 1. The 5% invest with a system, not reactions. 2. They manage risk before chasing returns. 3. They follow rules, not emotions. 4. They obsess over fees. 5. They keep going when things get hard. 6. They invest with knowledge, not tips. Now, does following all of these guarantee you'll get rich? Not necessarily. Your timeline matters, your income matters, your personal situation matters. But here's what I can tell you with complete confidence. The investors who consistently do these 6 things give themselves a dramatically better chance than the ones who don't. If you found this helpful, hit the like button and consider subscribing. We break down concepts like this every single week in a simple way, so investing stops feeling like a mystery. And if you want to go deeper, check out our video on the 7 things rich people do with their money. It pairs perfectly with everything we covered today and goes even further into the habits that actually build wealth. Thanks for watching, and see you very soon. Bye.